We spend so much time talking about the cloud, this invisible, weightless digital realm where all our data and artificial intelligence lives. It sounds so pristine.
Right, like it's completely detached from the physical world.
Exactly. Like
Yeah.
it just exists in the ether. But then you look at a day like today, July 23, 2026, and you realize, wow, that pristine digital cloud is entirely tethered to very physical, very messy realities.
Yeah, like shipping lanes.
And drone strikes.
Yeah.
And oil tankers. It is the ultimate reality check. So welcome to today's deep dive. Our mission today is to really unpack this massive, almost dizzying collision from the daily tech reader stack.
There is definitely a lot to process today.
There is. What we're looking at is a geopolitical energy shock slamming head-on into a brutal tech industry reality check. And the sources we're pulling from, they jump from naval combat in the Red Sea straight into the boardrooms of Silicon Valley and, well, eventually right into your own living room.
Which just proves how deeply and honestly, sometimes uncomfortably interconnected our globalized world is. I mean, a disruption in one node of the network doesn't stay contained. It instantly reverberates through the entire system.
Okay, let's unpack this. The geopolitical catalyst have to be our starting point because it's the domino knocking everything else over. Right now, we are on day 12 of U.S. strikes against Iran.
Yeah.
And simultaneously, Houthi rebels have just fired missiles and drones at 2 Saudi oil tankers in the Red Sea.
Claiming they're enforcing a maritime blockade.
Right. And before we get into the Washington response, we want to remind you that we are just unpacking the facts as presented in these reports today. We aren't endorsing any of the political positions being debated, but just looking at the raw data, the political response is incredibly fractured.
Oh, absolutely fractured.
You have the White House threatening, quote, major military punishment against the Houthis and vowing to hold Iran directly responsible. But then you look at Capitol Hill and it's a completely different story. How do global markets even price in that level of political chaos?
Well, they price it in with intense volatility because markets hate uncertainty more than anything else. I mean, you have the defense secretary disclosing that since February, the U.S. has already burned through $37.5 billion on the Iran conflict.
$37.5 billion.
Right. And the administration has an emergency supplemental funding request advancing in committee. Yet at the exact same time, you have the House of Representatives passing a resolution to halt military action entirely without explicit congressional authorization.
Although the Senate narrowly rejected a similar measure, right?
Exactly.
So you have the executive branch threatening escalation, while the legislative branch is deeply divided over whether they even have the constitutional authority or the budget to be fighting this war.
It's a massive constitutional war powers debate happening in real time during an active conflict.
Unbelievable.
And while Washington is paralyzed debating the strategy and the funding, the commodity markets, they aren't waiting for a resolution. The physical threat to those tankers in the Red Sea caused an immediate reaction. Brent crude oil just surged above $100 a barrel. Yeah, it hit $100.60, which is a 7% jump. We haven't seen Brent crude above 100 since May of last year.
So the Red Sea right now is basically like a closed valve on a pressurized pipe.
That's a great way to look at it.
The longer live fire forces ships to reroute entirely around Africa, the more pressure builds up in the supply chain.
Yeah.
But I want to push back on how we think about this. When I see oil up 30% this month, pushing the national gas average near $4.15 a gallon, is this just a localized geopolitical conflict that makes your commute a little more expensive, or is $100 oil essentially a global tax on everything we do?
It is absolutely a global tax. Think about the mechanics of it. Everything you buy, whether it's groceries, clothing, electronics, it all has to be shipped.
Right.
Everything requires energy to manufacture. So when the baseline cost of that energy spikes, it acts as a universal tax increase that drains disposable income from consumers and eats into the margins of businesses. The IMF actually issued a stark warning today confirming exactly this.
Oh.
Yeah, they stated that Brent crude at $100 is equivalent to a significant demand shock.
And the forecasts from the analysts in our sources are painting a pretty grim picture of where that pressure gauge goes next.
They are. RBC Capital Markets is warning that Brent crude could exceed its 2022 high of $128.
Watch.
And if this escalates into a worst-case scenario, meaning a full-scale regional war that physically destroys oil infrastructure, They project it could top the 2008 peak of $146 a barrel.
That is terrifying.
Yeah. And Goldman Sachs is separately warning that even without a regional war, a path to $120 is highly realistic if Iranian oil production is disrupted.
Beyond just the closure of the Strait of Hormuz.
Exactly.
So you have a massive geopolitical and energy shock acting as a tax on the entire global economy. But that $100 oil tax doesn't just hurt the consumer at the pump. It acts like gravity on the stock market.
It pulls everything down.
Which brings us to the brutal reality check hitting Silicon Valley today. The Magnificent Seven, that basket of the biggest tech giants just fell 5.3%. The sources note this is the worst single day they've had since the tariff meltdown back in April of 2025.
And you really see the panic when you look at Tesla's numbers. Tesla's Q2 earnings were a massive driver of this sell-off.
Even though on paper their revenue actually looks solid.
Right. They beat estimates with $28.24 billion, up 26% year over year. But Wall Street completely ignored that top-line beat.
Because when you look under the hood, the engine is sputtering. Earnings per share missed by 39%.
Huge miss.
Their operating margin plunged to a razor-thin 1.4%, and free cash flow hit negative $1.09 billion. Why is that company bringing in $28 billion in revenue suddenly burning through cash like that?
Because of the sheer physical cost of the AI revolution, their capital expenditure, or CapEx, surged 142% to nearly $5.8 billion.
What does $5.8 billion in CapEx actually buy?
Well, we aren't just talking about writing new software code here. It's securing hundreds of acres of land for data centers. It's siphoning massive amounts of power from the local grid. It's buying thousands of highly specialized, incredibly expensive NVIDIA chips.
Yeah.
And it's building advanced liquid cooling systems just to keep those server farms from literally melting down.
And Elon Musk didn't shy away from this on the earnings call. He explicitly warned investors that 2026 is going to be a, quote, massive CapEx year because they are pouring money into the Cybercab launch, the Optimus robot production, and building out all those AI data centers.
And Tesla is not an outlier here. Alphabet just raised their 2026 CapEx guidance to a staggering $195 to $205 billion.
$200 billion. That is insane.
It is. And that single announcement sparked a 6% sell-off in their stock, pulling Meta, Microsoft, and Amazon down with them.
Which brings up a huge question. Because for the last couple of years, the mandate from investors to these hyperscalers has been, build AI at all costs. Do not get left behind. So why are they suddenly punishing these companies for doing exactly what they were told to do?
What's fascinating here is the psychological shift happening on Wall Street. The narrative has completely pivoted. Investors are looking at these hundreds of billions of dollars going out the door, and they are asking, where is the ROI? Where is the return on investment?
They want to see the money.
Exactly. They are seriously doubting the timelines for when this massive AI infrastructure will actually start generating meaningful standalone profits.
It's like they're building the most expensive, elaborate interstate highway system in human history. They're pouring billions into the concrete, laying down 10-lane roads, putting up all the signs.
Yeah.
But Wall Street is looking at this beautiful empty highway and panicking because nobody has actually bought a car to drive on it yet.
That is a perfect way to visualize it. The infrastructure build-out is magnificent, but the commercial applications, the software subscriptions, the enterprise tools that actually generate revenue to justify that infrastructure, they just aren't scaling at the same speed.
But not everyone is losing in this scenario. If the companies building the AI highways, the Alphabets and the Teslas are taking a beating, the companies selling the shovels for this construction are telling a totally different story.
That's the anomaly in this tech crash. Look at Supermicro. Their shares actually surged because they reported a record backlog of orders for their AI servers.
Oh, wow.
Yeah, it proves that even if Wall Street investors are questioning the ROI, the hyperscalers themselves haven't slowed down the physical build-out at all. The demand for the hardware is still vastly outpacing the supply.
And we also saw ServiceNow jump 3% after hours. They beat Q2 estimates and raised their annual subscription revenue forecast, which is directly driven by demand for their AI enterprise software.
Right.
So businesses are buying AI tools. They just aren't buying them fast enough to justify Alphabet's $200 billion budget.
It is a highly localized infrastructure boom. But the critical thing to understand is that this localized AI boom is happening inside a much broader, much more suffocating macroeconomic squeeze.
So what does this all mean? How is a drone strike in the Red Sea interacting with server demand in Silicon Valley?
Through the bond market. Because of the U.S.-Iran conflict and oil crossing that $100 threshold, inflation fears have been completely reignited globally.
Yeah.
U.S. Treasury yields hit their highest levels of 2026 today, with the 10-year Treasury approaching 5%.
Let's break that down, because when Treasury yields go up, borrowing gets more expensive across the board.
Yeah.
Mortgages, car loans, corporate debt, it all costs more.
Exactly. A 5% yield on a 10-year Treasury acts like gravity on growth stocks. If an investor can get a guaranteed 5% return from the U.S. government, they are going to be far less patient waiting years for Alphabet's AI highway to start turning a profit.
That makes total sense.
We also saw a $21 billion TPS auction today. TPS are Treasury inflation-protected securities.
Okay, how does that auction actually work as an indicator?
Think of a TPS auction like buying insurance. When investors flock to TPS, they are essentially buying insurance against their money losing its purchasing power. That $21 billion auction means the smartest money in the room is terrified that $100 oil is going to trigger structural inflation, making everything more expensive for the next decade.
So the fear is very real and very quantifiable. And it's not just a U.S. problem.
Not at all. The ECB held their interest rates steady today, and they explicitly warned that the oil price shock from the Iran war is actively complicating their path to easing rates.
Thanks.
European equity markets slid in sympathy with the U.S., and it hit energy-importing economies like Germany, Italy, and Spain especially hard.
You can even see this macro squeeze hitting established legacy tech companies. I mean, IBM just cut their full-year revenue growth forecast down to 4 to 5%.
Yeah, they're definitely feeling the pinch.
They're seeing their mainframe and legacy software revenue decline. It basically confirms that corporate IT budgets are finite. If a company is spending millions upgrading to AI infrastructure, they're funding it by taking money away from their legacy systems.
It's a direct cannibalization of corporate spending. The pie isn't getting bigger, they are just slicing it differently.
So again, what does this all mean? If you are a regular investor or a business leader or just someone trying to manage a household budget, how are you supposed to navigate this dual-track economy? You've got AI infrastructure beaming on one side, but on the other side, energy costs are spiking, inflation fears are back, and the broader market is suffering its worst day in months.
It means recognizing that this macro squeeze isn't just a spreadsheet problem for Wall Street analysts. It is a highly physical stressor that is hitting consumer wallets right now.
Yeah.
And when economic pressure rises alongside intense geopolitical headlines, it actively shifts human behavior. People react. They look for ways to cope, and they look for an escape.
Which brings us to the domestic reality happening right now. Because it's not just the global markets running hot, it's the actual climate. Extreme weather is physically trapping millions of people indoors today. We've got Tropical Storm Bertha hitting the Houston-Galveston coast with 40 to 45 mile-per-hour wind gusts and heavy coastal rain.
And inland, there is absolutely no relief. Dangerous heat is expanding across the southern plains and the desert southwest.
It's brutal.
We are looking at heat indices above 105 degrees from Dallas all the way to Phoenix, plus a separate heat event in the Pacific Northwest shifting toward the northern plains.
So imagine the psychology of the consumer right now. You've got millions of people trapped inside by extreme heat or a tropical storm. They open their phones, and the news feeds are filled with a war in the Middle East, $100 oil, and a plunging stock market.
It's a lot to handle.
It creates this intense, immediate demand for what the sources refer to as the escapism economy.
When the real world feels overwhelmingly stressful and unpredictable, consumers flock to predictable, non-anxious distractions.
And the data supports this perfectly. Tonight is the Major League Baseball All-Star Game in Pittsburgh, broadcasting on Fox. Media analysts are projecting huge viewership numbers, specifically citing audiences seeking a, quote, sports break from this high-anxiety news cycle.
Sports provide a deeply controlled environment. The rules are clear, the timeline is set, the stakes are entirely contained to the field, and absolutely none of it has anything to do with inflation or global conflict. It functions as a psychological pressure release valve. And we are seeing the same appetite globally.
Right. The sources highlight the 2027 World Athletics Championships in Paris. They just launched ticket sales and are seeing unexpectedly massive demand. And organizers attribute this directly to the record-shattering viewership of the 2026 FIFA World Cup final.
People just want a break.
There is a universal craving for the communal distraction of international sporting events right now.
But There is a painful irony embedded in this escapism economy. The very companies that provide that escapism are getting caught in the exact same macroeconomic squeeze that consumers are trying to hide from.
Look at Netflix. Their shares dropped right alongside the broader market sell-off today. Last week, they were enjoying a streaming sentiment recovery, but that is entirely gone.
Completely wiped out.
Analysts are pointing out that with Brent oil at $100 and recession risks rising, Netflix's ad-supported streaming tier is incredibly vulnerable. Why? Because if consumers are spending $4.15 a gallon on gas, their disposable income evaporates.
Exactly.
They simply aren't buying the luxury goods, the cars, or the vacations shown in those streaming ads.
And advertisers are hyper aware of this. The moment consumer spending drops at the pump, advertisers pull back their ad spend to protect their own margins, and companies like Netflix take the immediate revenue hit.
It traps these media companies in a state of corporate limbo. And nowhere is that limbo more agonizing right now than with Paramount and Warner Bros. Discovery. They are desperately trying to execute a massive $111 billion merger to survive this environment.
Yeah, but they are completely frozen by an antitrust to the famous. Temporary restraining order, a TRO, until a federal hearing on August 4th.
What a mess.
What a TRO does in this context is legally paralyze both companies. They can't integrate, they can't restructure, they can't find synergies. They are stuck in a holding pattern while they bleed ad revenue due to the broader market turmoil and the suppressed consumer spending caused by the Iran war.
The irony is just staggering. I mean, just when legacy media companies desperately need a merger to survive a brutal economic environment, the government steps in and freezes it.
Right.
And just when everyday people need escapism on Netflix to tune out the anxiety of the world, Wall Street punishes Netflix's stock because those same people might not be able to afford the products being advertised to them between episodes. It is a perfectly closed loop of stress.
It really demonstrates the inescapable reality of this macro environment. A geopolitical shock doesn't just stay in its lane, it seeps into the foundation of every single sector.
So as we wrap up this deep dive, let's connect all the dots we've laid out from today's stack.
Yeah.
We started with an isolated drone strike, targeting a tanker in the Red Sea.
Which acted as a catalyst.
Right. That singular event acts as a closed valve on the supply chain, spiking global gas prices. That spike panics central banks like the ECB and the Fed, reigniting inflation fears and driving up treasury yields.
Yeah.
Those high yields make borrowing expensive, which crashes tech stocks because investors are suddenly terrified of the hundreds of billions being spent on AI infrastructure before there's a clear return on investment.
It's a massive chain reaction.
And all of that macroeconomic pressure trickles all the way down to dictate the vulnerability of the ads you watch on your TV tonight while you're trying to escape a 105-degree heat wave.
If we connect this to the bigger picture, today's data is a masterclass in modern systemic risk. There are absolutely no isolated incidents.
None.
A naval choke point in the Middle East is fundamentally linked to the power grid of a server farm in Silicon Valley, which is fundamentally linked to the disposable income in your household budget.
Which leaves us with a really fascinating question to ponder. We look at the sheer scale of what's happening. Global conflicts are instantly dictating the cost of our energy in moving markets. But at the exact same time, these tech giants, Alphabet, Tesla, Microsoft, are spending hundreds of billions of dollars on physical AI infrastructure that is essentially becoming a new digital utility.
The scale of that capital expenditure is astronomical. We are talking about hundreds of billions of dollars concentrated in a handful of boardrooms.
So the question we want to leave you with today is this. If global conflicts dictate our energy, but tech giants are building the infrastructure of the future at this scale, are we entering an era where a single tech company's capital expenditure budget is just as geopolitically significant to our daily lives and to the global economy as a sovereign nation's military budget?
It's definitely something to think about.
It is something to think about the next time you see the stock market violently react to a tech earnings call. Thank you so much for joining us on this deep dive. Stay curious, and we'll see you next time.